Last week, JPMorgan issued a report where they called Ethereum's recent activity, quote, disappointing. As an on-chain analyst in this video, I'm going to go through some of their conclusions and talk about what they got right and also what they're missing. Welcome back to Dynamo DeFi. My name is Patrick. As a reminder, nothing in this video is financial advice. This is solely for educational purposes. Now, let's get into the video. To start, let's look at some of the details of the report. I have this article here from the block, and JPMorgan's report was specifically about Ethereum's activity post-Shanghai upgrade. That's what they called disappointing. And if you're not familiar with the Shanghai upgrade, that was in April. And basically what it did, among other things, but the main thing that it did is it allowed people to start unstaking ETH. You've been able to stake ETH since late 2020. Ethereum's been fully proof of stake since mid to late 2022. And then you could actually only start unstaking your ETH in April of this year. And then this is really significant because before this, there was a lot of doubts if you staked ETH, how long it would be locked up for. They had their timeline, but it had been extended a couple times, and there was a lot of fear among some people that, could be years before you were able to actually unstake your ETH. And the fact that you can now unstake it after waiting in a queue means that people are a lot more confident in actually staking their ETH to secure the network. And if to go on and read a little bit more about what they say in the report, they wrote, quote, while the shift from proof of work to proof of stake that resulted from the merge upgrade meant that the energy consumption for the Ethereum network collapsed by more than 99%, the Ethereum supply is shrinking and staking rose sharply, with the amount of Ether staked up by 50% since the Shanghai upgrade. The increase in network activity has been rather disappointing. And they go on to note that Ethereum's daily transactions, daily active addresses, and total value locked, or TVL, of decentralized finance protocols in the network have experienced declines. And so let's zoom into this chart that they had there. We're going to focus on this a lot. So these are some of the stats they talk about. They talk about the market cap being down, daily transactions being down by 12%. We'll come back to the total staked ETH. They talk about DeFi TVL being down by 7.8%, daily active addresses down by 19.61%, etc. And that's from end of March to current. And unfortunately, I don't know exactly where they did the cutoff for this current thing, but I would assume it's sometime within the past few weeks to month. And so let's talk a bit about what they got right. First thing is staked ETH is up a lot, as I mentioned before. It's up 50%, and a lot of people were concerned that once you opened up the ability to have ETH withdrawals, that the amount of staked ETH would go down. However, that hasn't been the case. It's actually gone up, and like I mentioned earlier, that's because there's a lot of people who were hesitant to stake ETH because they wanted to make sure they had it liquid, and now they don't need to worry about that they can actually stake it and know that they'll be able to withdraw it probably within a few weeks. Second thing that they got right is, yes, the market cap is down, and that's largely a result of the entire crypto market being down from where it was in March. Some other things they know, and I'll say that this is good, is that they talk about some of the Ethereum layer 2s as well. So they talk about Arbitrum, they talk about Optimism, and they note TVL, transactions, active addresses for both of those networks. And something else that I want to note here is that I think in general, it's really good that JPMorgan is looking at on-chain data. One of my strong long-term theses about the crypto market is that crypto analysts and investors will shift away from using chart-based technical analysis as much, although that always has a role, and they'll shift towards using more on-chain analysis. I mean, one of the beautiful things about crypto is that you can get real-time, verifiable financial metrics for any blockchain protocols or applications built on blockchains, in real time. And so you can actually, that's an improvement, I would say, over traditional financial markets, because you can get these fundamentals, know that they're 100% accurate, and get them literally in real time as they change on a minute-to-minute basis. And so it's really great they're looking at these things. However, let's talk about some things that I think they may have overlooked in this report. One of these is they talk about DeFi TVL, and then to their credit, again, they look at it in terms of million ETH. So that's great. However, if we go to the main source of TVL, DeFi Llama, which is my preferred source of TVL, it's pretty much industry standard at this point. And we look at this, I will say I was unable to replicate their exact numbers on here. So I don't know if they're maybe doing a cutoff that's midday, or they have their own source, or they're doing some custom exclusions. You can see with these filters, I was able to get it to 3.92 on March 31st and 31.31 million ETH on March 30th. And they said 31.21. So probably this is roughly the filters they were doing. And the first thing that I want to note is that looks like they're including some things here, if these filters are accurate, that typically speaking, I would not include in total value locked, and many other analysts I know wouldn't include in total value locked. And so some of these things that look like they're probably being included are staking and pool 2. And what staking is that you have the native governance tokens of a protocol staked. That would, for example, be something like CRV for Curve, or other DeFi tokens, where you're staking the governance tokens of a protocol to participate in that protocol's governance. And it's somewhat controversial over whether to include those or not, but typically speaking, staking of protocols on a network often wouldn't be included, because that's going to make TVL fluctuate heavily based on the price of tokens on the network. And the second reason why they often might not be included would be that they they're not actually being used for anything, right? They're being used usually to participate in governance, but they're not being lent out. They're not being used as liquidity. They're not actually participating in the financial ecosystem. They're just being used to govern a protocol. Second thing that would often not be included is pool 2s, because again, that pool 2 is when you have a protocol incentivizes liquidity for their token to be paired with something else, such as ETH, right? So if you have a protocol and you want people to provide liquidity on your token, you'll give incentives for them to pair it with ETH, and that's called the pool 2. And this one, you can make an argument that it should be included. I go back and forth. However, oftentimes it's excluded for that same reason, that it would make TVL very dependent on prices in the network. So if the price of ETH dips, prices of DeFi tokens in the ETH network are going to dip even more, which causes the TVL to basically be an exaggerated version of price. And then the final one, which appears to be included, is borrows. And borrows basically means when you have a lending protocol, DeFi lending protocols are over collateralized. So if you're not familiar with crypto lending protocols, something like Aave, which is the largest one, it's going to be over collateralized. So there might be, for example, $6 billion deposited and $3 billion of that is borrowed as loans. That's not an exact number. I'm just estimating here. Okay, so it's actually looks like 6.4 is deposited, and about 2 billion of that is 2.2 is withdrawn as loans. And the reason why you might not necessarily include that is that there's going to be a lot of people who are depositing collateral. Say they're depositing Ethereum as collateral, BTC as collateral, and they're borrowing against it. Then they're converting that back to ETH or BTC, and they're depositing that again, and then they're borrowing again, and they're basically looping it like that. So in that case, you can actually sometimes basically have the same money that's deposited in the protocol multiple times. And so that's oftentimes when people measure total TVL, they will exclude borrows. And then it also looks like they're including liquid staking, and I would agree that is, yes, you should include liquid staking. And so the reason why I'm going through all these things is because this TVL number, which they know as being down, is actually somewhat subjective. So for example, you have, if you look at with these filters off and you go back to the start of March, then we would say, okay, looking at this here, Ethereum TVL in terms of ETH was 24 million, and now it's at 25 million. And so I think it's not as clear cut quite as they say that it's down. I think you can make the case that it's up slightly. But what I think is actually more significant is that when they look at these networks here, they include Arbitrum, they include Optimism, fantastic. However, since March, there's actually been several other layer 2s that have launched and gained a lot of traction. So if we go over here to this website L2B and look at activities on different layer 2s, we can see that the largest ones currently are ZK Sync, Era, Starknet, Base, and then Arbitrum, and then Mantle is actually over Optimism. And if you look at, for example, the total scaling factor since the end of March, then we can see, okay, so back then, the total layer 2s were running around 35 transactions per second on average. Now they're running around 52 transactions per second on average. So even though Ethereum activity is down, activity on some of these new layer 2s is up significantly. And even if you exclude ZK Sync Era and Starknet, which include a lot of airdrop farmers, then you still have Base, and you would still see that Base is doing more transactions than either Arbitrum or Optimism. And so that's one that definitely would warrant being included. And then the final thing that I would note about this report is that they mentioned the share of Lido in total staked ETH is up slightly from 31.37% to 32.26%. And I would agree that this is an important thing to note. They talk about that being a potential security risk. And yes, I would agree. Although my understanding is Lido is trying to make their set decentralized in some ways. As far as I know, it's not yet. And so that is a security risk. You don't want the control of the staked ETH supply to be too centralized. And that's what I would say JPMorgan got right and wrong in their report. If you want more on-chain analysis, want more stats like this, I have a weekly newsletter, dynamodefi.substack.com, where I go through all of this, go through my own analysis on the crypto market using on-chain data. And as soon as you subscribe, you will get a free book about how to do on-chain analysis yourself. Hope you enjoyed the video. If you want more like this, be sure to like and subscribe. And until next time, this is Dynamo DeFi.